even if we have a deflationary collapse like Rogers Webb thinks there will be, we could also have a hyperinflationary collapse. So, and even in the deflationary collapse, a lot of companies are going to go bust. A lot of people are going to go bankrupt, and they won't have any dollars or any pounds. But if you have gold and silver, you'll be very lucky. You'll be one of the few who has any, real money left. So I think it's going to be really hard. The only hope is that we get a hyperinflation and then it destroys everything. And I think it would ruin their plan for the Great Taking, because it's more of a deflationary collapse.
Since March 2022, the Fed has increased its key rate from near zero to approximately 5.4% in an attempt to curb inflation, which surged to a 4-decade high as the economy rebounded strongly from the pandemic recession in 2020. Analyst Jack Gamble expresses concerns about the compounding impact of inflation and higher interest rates, attributing the affordability crisis across the economy to the Federal Reserve's actions. He notes the Fed's efforts to suppress wage hikes to counter the affordability crisis, creating a dilemma where either wages must rise significantly or prices must drop drastically. Globally, increased economic problems have historically led to conflicts, as evidenced by ongoing or impending wars in various regions. Jack sees the U.S.'s tendency to involve itself in global conflicts as a significant risk factor. Another prominent analyst, Mario Ineco, offers a nuanced perspective on potential economic collapses, considering both deflationary and hyperinflationary scenarios. He envisions dire consequences in either situation, predicting severe business closures and bankruptcies, leaving many without adequate currency reserves. However, Mario views gold and silver holdings as genuine currency forms, providing security amid financial turmoil. During turbulent times, gold has consistently delivered impressive returns. According to WisdomTree, after Lehman Brothers' bankruptcy triggered the global financial crisis, gold returned 31.5%, compared to the S&P 500 stock index's 4.4% gain. Expressing concerns about prevailing economic challenges, Mario leans toward a bleak outlook, emphasizing the significant debt burdens, particularly government debt in the United States, which he believes significantly impacts the global economy. He warns that increasing interest costs and rising debt issuance could overshadow private sector growth and investment opportunities, affecting both the UK and global markets. Gold might benefit from the potential halt in rising interest rates. Recently, the price of gold reacted positively to encouraging consumer price data in the United States, alleviating inflation concerns. The Federal Reserve was compelled to significantly raise interest rates to manage the High Consumer Price Index, CPI. Consequently, U.S. public debt became more appealing as a safe haven asset, competing with gold during uncertain times. We will present clips from Jack Gamble and Mario Ineco with the Vancouver Resource Investment Conference interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Through the 1-2 punch of inflation and then higher interest rates to fight the inflation that the Fed created, the Fed has created an affordability crisis all across the economy, and they're doing everything they can to prevent wages from rising to solve that affordability crisis. So something's got to give there. Either wages have to lurch higher or prices have to come down sharply. And then geopolitically, obviously you've got, as economic crises mount up, what do world leaders typically do? Historically, they start wars. We're seeing that play out in real time, right? Virtually every corner of the world, there's either a hot war going on or there's the threat of war looming. And, the U.S. just feels the need to get involved in every conflict that springs up everywhere in the world. So that's obviously a risk. And then domestically, you've got this downward spiral towards totalitarianism, something that really accelerated with the pandemic. And that's continuing as Orwellian policies that are meant to be the stuff of science fiction become normalized. And along with that slide into totalitarianism, you have this normalization of political violence that's starting to spring up in the West, where, walk through a college campus, it's okay to punch somebody in the face because of a flag that they're waving or because of a hat that they're wearing. And we're equating somebody's opinion with an act of violence, and therefore it's okay to hurt that person because of the way they think. So you've got that going on at the same time as this march toward totalitarianism. And I think if you extrapolate that across a couple more years, it's really frightening where we might end up.
I think for me, the biggest problem, not just for the UK, but for the whole Western world, is the debt. And not just consumer, household, or corporate debt, but especially government debt, and especially in the States. And I know I'm in the UK, but the US affects the whole world. And with interest costs just going over $1 trillion, with maturing debt and debt that the Treasury will have to issue in the next year, going up to almost 8 trillion. It's going to crowd out the private sector, is going to crowd out investments. And in the UK as well, I spoke recently about how taxation, and if you add inflation, it's taking almost 60% of the economy, productive economy. So I think that's the major problem. So that's how I see things geopolitically. Yeah, I think it's all theater. And I know, unfortunately, people die and things happen, but all the wars are what they call bankers' wars, and they have been for 300 years. And I recently read an article in the FT that was talking about how the Bank of England, and I'm sure other central banks are involved with them, even though they didn't say anything about that. They're preparing for a massive, another massive bond crisis, not just gilt or treasury, but also corporate bonds. And the narrative they're trying to create is that a major geopolitical crisis will trigger that. So that's what makes me, I'm not really worried, because that's what they want you to be worried. But I think they will use an excuse of some crisis to basically say, look, the bond market collapsed, not because we've been printing and borrowing so much, trillions and trillions upon trillions for the last 15 or 20 years. No, it was because of what China did over there, or what Russia did over there, or what the BRICS were doing. So that's how I see things.
The U.S. economy faces intensified scrutiny as Moody's Investor Service downgrades its credit rating outlook from stable to negative. The decision, attributed to rising fiscal deficits and questionable debt affordability, has ignited conversations about the future of U.S. finances, global markets, and political dynamics. Mario sees that Moody's in particular is the only major agency that hasn't downgraded the U.S., while agencies like Fitch downgraded the U.S. in August. Mario notes that political problems within Congress hinder effective solutions, leading to concerns about the endless deficit spending without a clear resolution. He suggests that Moody's, though lagging, is catching up to the present scenario. Regarding the Moody's downgrade, Jack speculates it might be more related to the ongoing conflicts between the Fed and Congress, or the Fed and Treasury. He highlights concerns about rising interest costs on debts and the persistent increase in debt without corresponding spending cuts. He metaphorically likens the situation to parents fighting in front of their children, indicating that the citizens will bear the consequences of these conflicting policies regardless of the outcome. Let's get back to the interview.
Yeah, I think they didn't really downgrade, but they put them on negative watch. And Moody's is the only major agency that hasn't downgraded the U.S. from AAA. Back in August, I think it was Fitch downgraded the U.S.
Yeah.
And back in 2011 was Standard & Poor's. And I think it's mainly because they're seeing a lot of problem politically. It seems like Congress, either party, they can't get together. They can't solve anything. And I think people are starting to realize, and Moody's as well. And I would say Moody's is way behind the curve, but they've moved. Yeah, people are starting to worry that there's no end in sight to all the deficit spending. There's no political will from both sides to sit down and fix things. And I think anyway, it's if you look at that chart of the interest payments on U.S. debt, it's taken off since last year. It's going to be impossible to stop that. I think it's just a mathematical thing. So yeah, as for the economy, I think the only reason the economy looks like it's growing is because of all the deficit spending. So it's all the government. So Moody's, I mean, they're always behind the curve. So is S&P and Fitch. If anything, I would be rating all the major Western countries almost junk.
I do think they will continue the soft landing narrative. And no, I don't think the Moody's downgrade has anything to do with the concept of a soft landing. No, I am convinced that nobody who's paying attention honestly believes a soft landing is possible. The people who are saying it in the press don't believe it. It's you would have to ignore such a mountain of economic data to believe that that's even possible. It's never happened before. It's not going to happen now that the problem is even bigger. If you go around, most of the narrative of the soft landing, I think, is centered around, oh, look, the stock market is doing so well, it's up, and therefore we've nailed the soft landing. And most people maybe hearing that message look at the stock market as a barometer of the economy and say, okay, maybe we did stick the soft landing. But if you look at why the market is really up, the worse the news gets, the better the stock market does. That's not because of the soft landing narrative. That's because of the belief that the Fed is going to burr again, that they're going to ZIRP again, zero interest rate policy and money printing. So the narrative of the soft landing is predicated that asset prices are going to rise again. Why would asset prices rise? Because the Fed lowers rates and prints money. Those are not things that happen during good economic times. So really what the soft landing narrative is telling people, without actually using these words, that the Fed and the banks and Congress have screwed up on such an epic scale that any day now they're going to take us back to the policies that caused this inflation mess. That's not a soft landing. That means we've screwed up so big that we know they are going to rob the masses via inflation again, driving our asset prices up and making us richer at your expense. Now, whether they do that or not is still up for debate, but the soft landing crew believes that's what's going to happen. I do think the Moody's downgrade probably has more to do with this war that's going on and this fight that's going on between the Fed and Congress right now, or the Fed and Treasury. We'll lump Congress and the Treasury together. Moody's looks at the points that Mario brought up about the rising interest on the debt and the rising servicing cost. And then they're looking at the ridiculous condition in Congress where, assuming these people aren't just frozen in place, or assuming their handlers have been able to wheel them into the committee meeting to just vote yes, that these people are not going to cut spending. And so you've got the Fed raising the cost of debt service while the people are creating more and more debts. This is a game of chicken between these two organizations pulling in opposite directions. And I use the metaphor of parents fighting in front of their children. Doesn't matter who wins the argument, the kids lose, and we're the kids. So the Fed and Congress are arguing back and forth. No matter what happens, they're going to hurt us as the proposed solution to that.
The economic outlook seems uncertain, with the Fed's attempts to manage inflation through interest rate hikes posing a delicate situation. Precious metals may become more crucial as a safe financial option amidst rising debt and interest cost concerns. How might the economy be shaped by inflation, interest rates, and safe haven assets amidst current uncertainties? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.